and welcome to Sectors Up Close. I'm Elena Casas. Today our theme is shipping and my guest is Chris Beecham, Chief Market Analyst at IG. Well, do you remember this? When the giant Ever Given container ship blocked the Suez Canal for nearly a week last year, it held up $60 billion of global trade, caused a supply chain panic and dealt a salutary lesson on how much the global economy relies on shipping. But since, the sector has been struggling, with the Baltic Dry Index measuring prices paid for transporting dry bulk materials and seen as a leading indicator, down 42% this year to date. As recession fears mount, container shipping rates are down by around 2/3, although rates for carrying LNG have skyrocketed amid this year's energy crunch, with carriers facing the double challenge of being unable to land cargoes into Europe, where LNG storage is already full or close to it. So it's a complex and challenging picture for investors. But if you want to try your luck, there are specialist vehicles such as the Breakwave Dry Bulk Shipping ETF and the Sonic Shares Global Shipping ETF, whose constituents also carry consumer, industrial and energy products. Well, joining me now to share his analysis of this troubled sector is Chris Beecham, Chief Market Analyst at IG. Chris, hello, thanks for joining us. So we have, of course, seen a dramatic drop in the Baltic Dry Index by about 3/4 compared to its peak of a year ago. Is it just normalising after the pandemic surge in demand, or actually are we looking at something perhaps more foreboding for the economic future?
There's a lot of normalisation in it, but I think you've gone from feast to famine for the sector, whereas before it seemed as if demand would never weaken, I think, for shipping, given the way the world was catching up from the pandemic. Now, as you mentioned, with those recession fears really looming, I think there's a sense that demand is continuing to weaken across the board, and that situation is probably only going to get worse from here, I suspect.
What's that slump telling us then about the global economy?
Well, I actually think it tells us that we are in for a sustained period of weakness. We had the Bank of England last week warning about the UK economy facing perhaps 2 years of recession. It's not alone in that, really. The question, I don't think now, is really whether we have a recession, but how deep that will be. And shipping companies won't be immune from that either.
Well, Maersk, one of the biggest, predicted that growth will be broadly flat to negative in 2023 and tilted to the downside. So do you see any pockets of value here?
I think at the moment the risk is, as with so many other sectors, that the cheap things keep getting cheaper. I think perhaps you're looking at maybe those with natural gas and oil, perhaps the most obvious ones for the carriers, will hold up better, certainly because the demand is still there, because of the disruptions caused by the Ukraine war. But for most bulk shipping companies, I think the risk is that you just end up having to sit through a further period of underperformance.
You mentioned natural gas and oil there. For LNG tankers, shipping rates have multiplied about 500% this year due to the energy crisis, and there's a backlog of ships off the coast of Europe who are unable to unload because there's not enough storage. How do you expect this to play out in the tanker market?
Well, I think we'll just probably see that sort of relocation over the course of time. You'll see demand pick up elsewhere. A lot of the LNG companies will have to say, well, we can't get our stuff offloaded in Europe. We have to look, even if it means lower prices, perhaps in other parts of the globe. So you will see a natural rebalancing, and that will come as a hit to revenues over time. But nonetheless, it's something that will take a good few months, I think, to play out. Again, you have a second dislocation here following hard on the heels of the pandemic.
A year ago, we were talking a lot about inflation caused by supply chain problems and the cost of container shipping, particularly from China. Now, big manufacturers, big retailers seem to be suffering the opposite problem, where they have warehouses backing up with goods and inventory that hasn't yet been sold. How is this going to come back into balance, do you think?
Well, I think it, again, takes that recession to work that out. And that's, again, I think a longer term, or maybe year-long exercise in destocking, because the demand simply isn't there at the moment to knock out those warehouses quite as quickly as perhaps shipping companies would like. So this is a longer term process, which means you will see demand recover. We're not talking about a much longer term slump in demand, but it is something that I think, because of the pandemic and the rebound and the sudden slump, takes even longer than normal, I think, to work itself out.
From an investor perspective, is this a sector people should be staying away from at the moment? And if not, how is best to approach it?
I think it is one you have to approach with caution, because ultimately it is tied to, as we saw with the share price of these companies over the summer, the risk on, risk off move generally. We thought that the Fed would pivot, that led the market to rally, shipping companies rallied, but they've come off since then. And I think, as we saw last week with the Fed really reiterating its commitment to hiking rates, things will continue to weaken before they get better.
Well, thanks so much for that insight, Chris Beecham, Chief Markets Analyst at IG. And that's your roundup of the shipping sector. I'm Elena Casas, and this is Reuters.